Let's dive into the content now. First, what actually is customer value management and why is it important? And let's probably start with the basics. What you see on this slide is the most simple firm way of how firms are structured. You have or will have classes on organizational behavior, where my colleagues will explain you in much more detail how firms look like. But in a nutshell, every firm has three main constituents. The employees, who actually do the work and produce the goods and services, be it a washing machine or a dryer or a computer game or a mobile game. The managers who manage those employees, and the shareholders who provide the capital, own the corporation, and who have to pay the bill once the company runs into financial problems, for example. Now, you also will have or already had the classes on corporate strategy. So you probably know that corporate strategy is usually referred to as the search for a sustainable competitive advantage. Now, one question that you can ask yourself is, what does this actually mean, sustainable competitive advantage? And if you look a little bit more in the literature, what you will find is that competitive advantage is usually defined as the ability to create superior economic value, more value than your competitors create. Above average performance in the long run, sustained superior financial performance, a persistent ability to have high relative profitability. We talk about how to define value in a minute, but that's about what corporate strategy is. A good strategy means you create more value than your competitors do. And this has often been equated to the creation of shareholder value, or in a nutshell, to the creation of high firm value. There's a very famous person called Milton Friedman who won the Nobel Prize in 1976, who essentially said that the only thing that firms can do and that firms are expected to do and can be expected to do is to make profit. And the idea of Milton Friedman was really simple. He essentially thought that this is what firms are good at. A company like Apple is good at producing high-tech gadgets and earning money in return. They are probably less good in other things. So why don't we just let them do what they are good at? And if you, as a society, want other things, good work conditions, protection of the environment, SDG goals, climate goals, whatever it is, then probably it's more efficient to let the firm do whatever they want, tax the firm, and use the tax money to let the state take care of all these other things. We come back in a minute whether this view still makes sense or not. But that was the view that Milton Friedman had. Let the firms do whatever they can do. And if you want, put laws on them that restrict whatever they can do, tax them, and use the tax income to do anything else that you think society should do. And this is reflected in the very famous quote of Alfred Prickett Sloan, who said, GM is not in the business of making cars. GM is in the business of making money. So this mindset is something very fundamental that we will see again and again in this class, that the main purpose of the firm is to create value, money, however you want to define it. Well, let's probably talk a second about this. How can you define making money? Well, there are lots of measures that we use in marketing and beyond to define how much value we have created. There are secondary measures like market share, growth rates, profit margins, firm size. But the problem of these measures is that very often they are very weakly correlated with actual value creation. Assume you create a new company. You want to sell new phones. You want to create a new airline. You want to create whatever you want. Let's assume we're creating a new airline, an airline that flies from Paris to New York. If we give away the tickets for free, and assuming our service and everything else is perfect, in a couple of months, we probably have 100% market share on the Paris to New York route. Why would anyone take another airline except of ours if we provide good service, good food, good schedules, good planes for zero cost for the ticket? So market share would be extremely high, but profit would be negative, extremely negative, because we don't have any revenue, we only have cost. Now, this is probably a stupid example, but you can find many, many other cases where the relationship between market share, growth rates, and profit margins and ultimate value creation is probably less strong than it should be. Well, this brings us to other things like accounting-based measures, economic profit, earning after taxes, earnings per share, return on asset, return on equity. Well, the problem with accounting-based measures is that they are not only impacted by the actual value creation of the firm, but also about their accounting rules. And in an accounting class, you will probably learn that there are many, many ways how you can interpret the same rules, and companies do this in very specific ways to shift profits from one country to another, to limit their tax burden, and so on and so forth. So secondary measures and accounting-based measures are not ideal. And this is why we usually refer to market-based measures. And the most common market-based measure is shareholder value. In a finance class, you will learn a lot about shareholder value, what it means, how it can be measured. But for this class, let's make it simple and assume that shareholder value is the same as market capitalization. It's the number of outstanding shares and the closing price per share. If your company has 1,000 shares that float around on the stock markets of the world, and each share is worth $1, then your company is worth $1,000. If tomorrow your share price increases to $2, your company is now worth $2,000. And for the purpose of this course, let's assume that this is what firms worry about. Firms want to maximize shareholder value and market capitalization. This means a year has been a good year when the share price is 10% higher at 31st of December than it was at the 1st of January. If you want to put this into more colloquial terms, what you can say is that firms try to assume that they want to get as rich as possible, obviously within the legal boundaries of their jurisdiction. Now, what you may wonder is probably, and what you may think is probably, that this is a very, very outdated view. Today, we talk so much about ESG goals, about social pressure, about corporate social responsibility, about sustainability. So a focus on money alone may seem to be very, very limiting. And yes, it probably is limiting, but let's look a little bit more into how the extension from shareholder value to ESG and other goals may actually impact firm strategy. Because firms do lots of things that probably on first sight may not look as if they create shareholder value. For example, firms may decide to adopt rules for their production or for clean air or for manufacturing that are much, much stricter than the rules that the law imposes. And on first sight, you might think that they are doing this because they care more about the environment than the law requires them to. But if you dig deeper, very often what you will see is that firms obey to stricter rules, not necessarily because they care for the environment, but because they anticipate that the rules will become stricter over time, and therefore it's more efficient for them to adapt once than to adapt multiple times over a certain given time frame. Or you may see that firms do great things like restructuring their supply chain routes in order to reduce CO2 emissions. And yes, probably firms care about CO2 emissions, but in many cases, what firms care about is cost. And a more efficient supply chain system means less supply chain cost, means more profit. So even actions that occasionally look like they have no relationship with shareholder value or value creation, and probably are taken by firms because they want to do something else, at the end of the day, very, very often boil down to an increase in market capitalization and shareholder value. But let's go back to these ESG goals that everyone is talking about these days. Firms today talk a lot about ESG criteria, environmental, social, and governance goals. And you may remember in the last US presidential election, Elizabeth Warren, who was a candidate for the presidency position at some point, says that being a big company is not a right, but a privilege. And what she wanted to do is she wanted to introduce charters, essentially rules that companies ought to declare that force companies to do more than simple value creation. Now, how does this fit with this idea of Milton Friedman that I presented you a couple of minutes ago, that we should firms just leave them alone and let them do whatever they want? Well, what people say nowadays is that nowadays firms are becoming much bigger than they used to be. A firm nowadays is much bigger, more powerful, and more impactful than probably a firm was in the 70s when Mr. Friedman won his Nobel Prize. The fact that firms are so big can mean that when they make a certain damage, this damage can no longer be fixed later by any government of the world. At the presidential election of Mr. Trump, there was a lot of discussion that probably Fake news spread on social media and very specific type of advertising on social media might have influenced the voting outcome. Facebook has become so important for many people as an information source that this is actually a conceivable hypothesis that the voting outcome has been impacted by Facebook. And the power of Facebook is so large that afterwards, this problem can no longer be fixed. So the idea is we can no longer let firms do whatever they want to do, but instead we need to control firms from the beginning and probably force firms, or at least encourage firms, to take care of other things than simple shareholder value creation. In addition, this broader focus is very attractive for the new generation of consumers and employees, so for people like you, because you care a lot about the environment, you care a lot about things outside of the traditional shareholder value paradigm, and you want to either be a customer or an employee of a company who also cares about these things. And while I do not criticize this viewpoint, I'd like to step back for 1 second and ask a very critical question. This is about accountability. How do you measure all these other goals that go outside of shareholder value creation? If the only focus you have is shareholder value creation, measurement becomes really easy. A year has been a good year if your share price has increased by 1, 2, 3, 5, 20%, and it has a bad year if it has decreased. But what if you have to choose between two scenarios? Scenario 1 is your share price goes up by 10%. Scenario 2 is your share price goes up by 9%, but CO2 emissions went down by 5%. Which one is better? How do you make a trade-off between CO2 emissions and shareholder value changes? Is 1% shareholder value a good price for 5%, or should 1% shareholder value translate in 10% less CO2 emissions? And the fact that these ESG goals are very often, still today, very hard to measure, very hard to track, and very hard to trade off, makes it really, really hard for firms to focus on them in an appropriate way. In addition, one key hypothesis that many people have is that this shareholder is this greedy person that is behind the firm and just wants to earn as much money as possible. But in most settings, the average shareholder is either an individual who invests money for their pension, or even more complicated, an institutional investor, a pension fund who invests money for the pension of other people. If companies no longer focus on shareholder value, their return will probably go down, which means these pension funds get less return, which means it translates directly into your pension. So again, I do not want to criticize the focus on ESG goals, but I probably want to make a case that focusing on shareholder value creation is probably less an outdated view than it might have appeared to you a couple of minutes ago. This is very closely related to the work of Michael Porter, and this is part of one of the additional materials that you have about creating shared value, CSV. Creating shared value means that firms should do things that are probably good for the environment or for society at large, while at the same time helping them to increase profit. And the article, as well as this slide, include a couple of examples about this. Now, obviously, all of this only applies to actual profit firms. Actually, technically, it only applies to traded companies. But even if you are not traded on the stock market, there are ways how you can calculate an approximation of shareholder value. But obviously, if you are a non-profit organization, this logic does not apply. There are many non-profit organizations, the Mayo Clinic, the Red Cross, the Museum of Modern Art. There are foundations like the Bill and Melinda Gates Foundation, the Stichting Inga Foundation, lots of different. Some of them are created for pure tax reasons, but in many cases, these non-profit organizations are there because of market failure, because we need some other entity than a profit-based company to provide those services. Now, while many of the tools that we will talk to in this class also can be applied to non-profit organizations. Loyalty programs, for example, can be as well applied for a museum than for a company. There are some exceptions here, and this class does not focus on that. We focus on profit organizations and not on non-profit organizations. Now, in this logic, how does marketing look like? Well, in this logic, there are two key entities. There are the customers on one side who have money, and the firm on the other side who wants to get that money and translate it into shareholder value creation. And in the middle is marketing. And what does marketing do? Well, marketing produces products. every product that a firm produces is a tool to get money from you. You get the product, I get the money from you. And whatever you will ever learn about new product design very often has this monetary aspect in mind. Later, we talk about something like conjoint analysis in a later session that deals with product design decisions, and that makes this link between product design and money very, very clear. There's place, which is the tool to get the product to the people. Sometimes it can be an actual physical distribution, like a supermarket. Sometimes it can be solidly digital, like when you download a game from an app store. Whatever it is, there's always a structure that the product comes to the people and the money comes from the people to the company. Promotion is everything that we do in order to set that train in motion, in order to make you want that product. Promotion includes everything from advertising up to influencer marketing on TikTok, on Instagram. And we talk about things like this in the next session. Price, which is what we talk about in the second half of this class, is the decision of how much money we can charge for the products we want to sell. And CRM, customer relationship management, which is what the first part of this class is about, is how can we make customers come back over and over again and buy our products. So to summarize, in this class, we assume that the focus of the firm is to maximize their shareholder value or market capitalization. And even if this might appear as an outdated view nowadays, it is probably less outdated than it seems, and it still applies to most firms in the world, except for non-profit organizations.